If you live in North Carolina or you're into NASCAR, you've probably heard about top money NASCAR driver Kyle Busch and his wife Samantha suing Pacific Life and his agent. And he even went on the news, and him and his wife were warning people not to do what he did. Here's a little snippet.
This isn't happening to athletes and celebrities. Right. This is happening to teachers, police officers, veterans.
Honestly, I'm thinking she's a little more pissed off than he is. The Bushes bought an indexed universal life policy, and that went seriously south on them. And according to the lawsuit, they lost $8.5 million because of misrepresentation about the policy from the agent and the insurance company. Now, in my experience, what this is going to do is simply add fuel to the fire for guys like Dave Ramsey and Clark Howard and quote unquote other consumer advisors who are just IUL haters, especially Dave Ramsey, who calls IULs or any permanent life insurance garbage. They won't look at the facts. They'll simply point to this fiasco and as proof that IULs are bad and should be avoided like poison. This is hugely biased bullshit. But here's the facts. I dug through the whole 50-page complaint. And based on that and my expertise, and by the way, I am the author of The Millennial Money Tree, How to Literally Ensure Financial Security in Your Golden Years, which the whole subject of that book is IULs. So I know a little bit about it, obviously. This wasn't an incident that's caused by an IUL being a terrible product, so much as being by terrible advice, poor design choices, certainly a poor choice of policy providers, and a super bad policy, and outright sales misconduct. I mean, seriously. But I'll go into this a little deeper in a moment. It was equally a problem of a lack of personal accountability, in my opinion. Verification and oversight by people he pays to act in his best interest and that of his family. In my opinion, several other people should be enjoined in that lawsuit, including his financial advisor, his CPA or tax advisor, or the firm that represents both of them, or certainly whoever pointed him to this agent that he eventually bought the policy from. But based on what's in the lawsuit, from what I can see, the damages stem from 4 agent failures. Exaggerated claims about the product is number 1. Okay, Kyle was told that the policies would be fully funded in a few years. That's flat out wrong. No IUL is ever fully funded. The contract language calls IULs flexible premium adjustable life. And that's exactly what it is. It gives you flexibility to fund how you choose. And the insurer makes adjustments internally based on what that funding is and how the policies is performing. That flexibility is actually the IUL strength. Done right, you can compress costs, get more money working for you sooner, and create a favorable risk/reward. But Kyle's policies apparently weren't structured to take advantage of that. Exactly the opposite. The agent's trust me bro assurances about funding and self-sustainability were way outside reasonable expectations, which brings us to number 2. Atrocious commission-heavy policy designs. The first rule of any cash value policy is wrap the smallest death benefit around the most cash value. You want the least insurance the IRS requires and the most premium allowed by law to go into cash value. That minimizes the cost as a percentage of cash and maximizes growth potential. Kyle's policies weren't even funded up to the modified endowment contract levels. That's called MEC for shorts. Those are limits that are, if they're exceeded, they make the policy income completely taxable. So you want to avoid those. So, really, you just want to stay within those limits. But if your year 1 funding is larger than subsequent years, that's usually a red flag that the design isn't optimized. So the next level of good design is using term riders to create capacity. Term riders let you inflate the cash value by overfunding and keeping the overall policy costs down. Kyle's policies had no term riders. So most buyers don't even know those exist. That's a massive missed opportunity and smells like commission-driven design. So, obviously, again, somebody was selling a bill of goods. Number 3 is unnecessary replacement. So we call it churning. So when a client realizes that an older policy is underperforming, many agents are happy to replace it immediately, doing what's called a 1035 exchange, which is exchanging an old policy for a new one. But those replacements often generate new commissions and replacing assets, resets, surrender schedules. So that's more money. It triggers new upfront loads and commissions and is often the wrong immediate move. I mean, almost always. I always say there are 3 options for older policies. A, do nothing, leave the policy as is. B, shrink wrap it or kind of optimize the existing policy and fund a new, better performing policy alongside it. Or C, replace the old policy and 1035 the cash value into a new one. Now, almost always, C can be the best term solution, but only if it's done right at the inception of a new policy so that no new charges occur. Now, Kyle's advisory team, and I use that term loosely because it appears that they were all crooks and interested in their own wallets instead of the Bush's, they apparently pushed the replacement behavior totally improperly. They did a 1035 4 years into the policy in 2022. Which functionally hit the reset button. So there was new upfront charges, new huge commissions, new surrender schedules, and each one of those further drained the cash value. So number 4 was sales tactics centered on emotion over math. Salespeople often create common enemies, banks, Wall Street, the tax man, in order to motivate buyers emotionally instead of providing clear math. In the communications to Kyle, both from the agents and the Pacific Life staff, they fed him the possibility of higher taxes under the Biden administration just to justify the 7-figure premium pushes. That rhetorical tactic to vilify banks and the tax man is common among infinite banking sales pitches too. So the problem is philosophy isn't a substitute for precise conservative illustrations and planning. You need both. However, these are the failures that played out in Kyle Busch's case. Kyle and his wife Samantha reportedly paid $10.4 million into several Pacific Life IUL policies between 2018 and 2022. They later received notices demanding more premium to prevent lapse, because the policies didn't switch to death benefits options as promised. So the net amount at risk stayed high, so internal insurance charges stayed high, and that eroded the cash value. Now the delayed 1035 exchange in 2022, over time, high insurance charges plus underperforming index crediting reportedly reduced their cash value to the point of an estimated $8 million loss. Despite rumors, there were no premium finance loans involved. It was just structured design problems that slowly cannibalized the value. Now, here's some key product realities that people ignore. IULs are flexible premium adjustment products. That means that they can be engineered to perform well if you choose the right company, design the policy correctly, fund aggressively, preferably from day one, and actively monitor and adjust the policy over time. But they're also fragile in the way that if the death benefit option isn't switched at the right time or your internal funding assumptions aren't met, the cost of insurance can cannibalize your cash value, which is exactly what happened in this case. So how do you actually use an IUL sensibly? A practical checklist is pretty simple. Choose design, fund, and monitor your policy. All four are required. Okay? Don't start an IUL unless you can overfund it early. There's a sweet spot in buying as little insurance as the IRS requires and stuffing as much premium into the contract as the IRS allows. That keeps the internal costs low. If you're going to do a 1035 exchange, do it at the policy inception, not years later. Doing it midstream often restarts the surrender schedules and adds upfront costs and commissions. And stress test the illustrations. Ask, what if the cap drops 2 points? Or what if the cost of the insurance rises faster than expected? Look at the downside scenarios in every case, not just a sales illustration, shiny best case, because that's what they're going to show you. I mean, they're not going to show you what can happen if something screws up. You got to ask. And avoid exotic gimmicks. There are all sorts of things like multipliers and indexing strategies and these flashy options that are available now that come with higher internal costs and no track record. Simple is better. Always, always, always look for the simplest solution so that you can make these things work right. When they work right, they're beautiful. If they're structured wrong, they suck. Simple as that. So use term riders to increase overfunding capacity and reduce cost structure whenever you can. Okay? And an insurance agent who is expert in IULs can explain how that works. And always have a contingency plan for maximum funding. If the market's conditions or company rules change, you need to be able to, move things around. So where does an IUL really fit into a modern retirement strategy? I mean, IULs are one of the 7 assets that I teach in my program. So, I think they're absolutely necessary for anybody to have a complete financial independence plan. They just make sense. If you understand them and you create them structurally correctly, they are a wealth legacy machine. They will make generational wealth for your family like it's going out of style. But IULs should never be sold as a silver bullet, kind of standalone tax-free retirement product like they were with Kyle. The way I teach it, it is one of 7 assets that you stack. Okay? Don't use it all by itself. When optimized correctly, IULs can offer locked-in loan rates that are lower than market and the potential for double-digit credited growth in good years. So when the market goes badly, you don't lose anything. Make sense? Now, a due diligence checklist. This is something that both you and your advisor must do. These things are it's just, you're a dummy if you don't. Simple as that. First, number 1, find a well-vetted expert in IULs instead of someone like Kyle's agent who had, by the way, a criminal record and multiple disciplinary actions by the North Carolina insurance regulators for misleading information and misrepresentation. That information was not hard to find. It took me all of 5 minutes. And it just makes me want to slap Kyle upside the head for not taking the personal accountability to protect his own family. Come on. It's kind of common sense. You don't just trust anybody. I don't know. Whoever pointed this guy to Kyle really needs to be in that lawsuit. So, next is shop multiple IUL carriers and source the best company for your goals. Despite the fact that Pacific Life sells thousands of life insurance policies every year, they are well known in the industry for having one of the worst IULs in the business. Nobody that I know would ever recommend a Pacific Life IUL policy for their client. Simple as that. You also want to plan for maximum funding and create contingency strategies if assumptions change. Okay, you need to be aware of that kind of stuff. And after you've found what you think is a great policy, get a second opinion from a firm like Wealth Legacy Advisors who do policy reviews online. You just go to the internet and look them up. I think the guy's name is Matt Decker. Check him out. And then, of course, monitor and service and actively manicure these policies over time. Annual reviews, stress testing, and proactive tweaks when they're required. Now, here's why, from my perspective, here's why the Kyle Busch lawsuit really matters. I mean, obviously, this is a wake-up call to the industry, by the way, because all of Kyle's problems could have been avoided with competent design, honest disclosures, and ongoing oversight. I mean, I still want to kick his team in the behind because, I mean, seriously, the guy's rich. He's paying all these people to look after him, and they did nothing. I just don't understand how that even happened. So, I mean, if this lawsuit really curbs the shady agent tactics, it's a big win for consumers. And I've been a fervent consumer advocate for many, many years, and just like beat up the insurance industry quite a bit. Now, obviously, too, this case shows what happens if agents prioritize commissions and sell with fear and emotion and don't really do the math. So, rules to live by. Never, ever take a trust me bro sales pitch. Demand modeled scenarios with downside stress tests. Don't 1035 midstream without modeling any sort of impact. I would just say don't 1035 midstream, period. If you're going to 1035, do it immediately at the inception of the policy. If you have an older policy, run that 3-option model. Do nothing, optimize, replace. Make sure you have clear math and timelines. Okay? Use IULs as a broader multi-stream tax-free retirement plan, not as the only arrow in your quiver. Okay? Use it along with all these other kinds of assets that I teach with the 7-asset program. So, also, of course, work with a fiduciary-minded advisor who understands not just tax law and policy mechanics, but also the sales illustrations. They have to be expert. Don't be Kyle. Don't sign over trust me assurances without the math to back them up. Simple as that.